All right, in today's video, we are going to talk about someone who is getting ready for retirement, and we're going to go over how we helped him plan for retirement and really make sure that he has enough money throughout the duration of his retirement and he can keep on growing his money too. This individual is 63 years old. He's getting ready to retire in about 4 years, so he's going to retire at the age of 67. Now, before we start going through the details, I just want to mention something here. He has made it very, very clear that he does not want his money in the stock market. He does not like the risk and seeing his money fluctuate up and down. It is just not his thing. This is something we did discuss and asked him about several times. And when it comes to the stock market, it's been no, not interested. Let's look at safe products, which we're going to look at insurance products in this video, particularly life insurance and annuities. So with his particular situation, he's still working right now. His working income has been about $100,000 per year. That is his gross before tax income, which means his net after tax income has been about $75,000 per year. Been a little bit higher than that in reality, but just based on the numbers we ran for him in the sake of keeping this video simple, it's about $75K per year after tax. And he and his wife have been very comfortable with this dollar amount. So this is the target amount, meaning when he retires at 67 years old, we want to target at least $75,000 per year. This is a number he's very comfortable with. When he retires, him and his wife are planning on downsizing. So the $75K that they're living on right now, he feels very comfortable with that. So that's the number we are going to target, but you'll notice we do want to inflate it a little bit because there's this thing called inflation, which is very real. That $75K might feel like $50K 10 or 20 years from now. So his current net worth, a little bit more than $1.1 million. The majority of it is in a brokerage account that has been in the stock market, and it makes him extremely uncomfortable. He wants to get it out. Then you see that he's got cash on hand, some small retirement accounts, and his home that's worth $480,000, and he has a mortgage balance of about $210,000. Now, on his home, he does plan on selling this and downsizing, so he's in a good position right now. Okay, so what we want to look at is what he's going to have at age 67. Getting ready for retirement. How we're going to get ready for retirement is we're going to look at what his life will look like at age 67. If he does nothing, what does he know that he will have in retirement income? And then look at some products and solutions that can increase the income and grow his money safely. So here is his current picture. Right now, he knows at age 67, he's going to have Social Security income of about $34,000 per year. At that point in time, his wife's Social Security income will be 50% of his, $17,000 per year. She's actually receiving Social Security right now of about $1,000 per month or $12K per year. But with Social Security, what happens is once he starts taking his spouse, his wife in this case, will get 50% of his benefit because it's more than the $12K per year she's currently getting. He'll get a pension benefit of about $5,000 per year, and the total income he'll receive before tax will be $56K per year, and then after tax, based on his current tax rate, and when we put this together, is about $50,000 annually. Will that work in retirement? No. Target amount, $75K per year. That's how much he knows he needs to live on, or how much he wants to live on. He did say, I've talked to my wife about cutting back a little bit, and we can do it. And during that conversation, I said, that's great if you guys can do that. However, if we can build out a plan where you can have at least that income and even more, would you prefer that? Especially since inflation over the past couple of years has been a very real thing to a lot of people. We want to account for inflation, and if we can give you more money, that puts you in a much better position where this way you don't have that stress about finance. Oh, are we going to have enough money this month? Like, you don't want that in retirement, or feeling like you have to go back to work. So target amount, 75K. His income, based on this info, 50K per year. Okay, that's a deficit of 25K per year. It's not enough. It's more than two grand per month. And these are the net after-tax numbers. So the goal here is to fill the gap. The target income is $75,000. So here's what we're going to do. We're going to use the money in the brokerage account that has been in the market, and he's explicitly stated that he wants it out of there. We're going to use that to first replace the income gap to make sure we have at least 75K per year of income. And then second, we grow the money safely. Does that make sense? So with this 750 grand, I want to make sure that you can live on 75,000 per year, and if possible, still see your money grow without any stock market risk. That's what we want to do. So we're going to look at three options here. Option A, we'll put 100% of that 750 grand into a whole life insurance policy. Now, this individual has experience with whole life insurance, particularly for the cash value. He was attracted to this idea, and the main reason why is because of the tax benefits. He said, if I can get my tax bracket close to 0% in retirement, that is attractive to me. So we did look at this option. Option B, we looked at no life insurance and putting 100% of that 750 grand into an income annuity. What you can do with an income annuity is buy the future income. It's basically what you're doing, because you do have a guaranteed income payment. It's guaranteed by the insurance company, meaning if you give them 750 grand and you want to start taking income at 67 years old, assuming you make this purchase at age 63, they say to you, thank you for your money. We guarantee that you're going to receive about $80,000 per year for the rest of your life, based on the rates at the time that you make the purchase. But you've got that word guarantee in there. So this will guarantee a lot of income. And then option C, we'll look at splitting it, because this will give you 50% whole life insurance with the tax benefits and also some liquidity, and then 50% annuity, so you can guarantee some additional income to what we know we're already getting. So a couple bullet points on this. With the whole life insurance policy, in terms of the cash value aspect, if we set up the policy properly, which is the most important piece, if we don't set it up right or design it with minimum insurance expenses and maximum cash value from day one, the plan's not going to work. He's going to have low cash value and he won't be able to use it how he wants to. So if you do that, he can grow the money safely. He has access to the cash value, meaning the balance. So if he's taking income from this policy, say 30 grand per year from the cash value, and one year he says, I want $50,000, he can do that with a whole life insurance policy. It's extremely liquid. It's very easy to access the cash value. Whatever the balance is, you can easily access that. And then third, the tax benefits were very appealing to him. He could access the money income tax-free, assuming we follow the IRS rules, meaning we don't trigger a modified endowment contract or lapse the policy, cancel it with a gain. That's another example of when taxes can occur. So that's the whole life policy. Then we've got the annuity. So with the annuity, that's going to guarantee him income. That's the upside. It's very easy. I just know with peace of mind the dollar amount I'm going to get. We'll see those numbers in a minute. The drawback here is that I have limited access to the account balance. So we said before, this is kind of like buying income. I say, here's a check, insurance company, and they say, thank you for your money. Here's how much income you're going to get. That's why I like to say buying income. What I give up is a lot of access to the principal balance. Yes, I can access some, but it's going to be extremely limited. Once I purchase this annuity for the income, I do want to have the expectation set that I'm not going to have much access to the principal balance. Does that make sense? Okay. And then third, when you take income, you are going to pay taxes on the gains. This is a non-qualified annuity, meaning this $750,000 is not coming from a 401k or a qualified account. It's coming from a brokerage account, which was funded with after-tax dollars. So what that means is when he starts taking income, the $750,000, that's his principal payment. I would not have to pay income tax on that. However, everything above the $750,000, I would have to pay tax on. It's not capital gains tax, it's income tax. And this is specifically when you take income from the product. Meaning when it grows, I'm not paying any income tax or any taxes because it grows tax deferred. Make sense? All right, cool. So just to summarize these 2 points, with a whole life insurance policy, the income is tax-free, but I get less money than what I'd get with an annuity. With an annuity, the income is not tax-free. I have to pay income tax on the gains, but I'll get more income than what a life insurance policy can produce. Which one would you like? Not enough information yet. Here's why. Here's the question I would ask if I'm you. And we asked this question for him when we put this together. Since the tax benefit is something that you're very, very attracted to with the life insurance policy, if you decide to go with the annuity, I would ask, if I'm you, how much more do I get? Meaning, how much more income do I get? And after I pay taxes, do I still net more with the annuity strategy than I do with the whole life insurance strategy? And then when I look at everything, does it make sense to just split it down the middle? I want to see how much income I get, meaning how much income do I actually get when I'm retired, and then how much cash do I have left over? So let's look at our 3 options. But before we look at option A, let's look at where his life is right now. We hit on this briefly earlier. Remember we said it was about 50 grand? Here you go. So at age 67, right here is where we want to start. You've got the Social Security for him and his wife. You've got the pension of about 5 grand. And we said 50K. Here are his actual numbers. Here's the before tax income, and then here's the after tax income of about 50K. And this is with no solutions recommended. So we're not looking at life insurance, annuities, nothing in this example. We would assume that the funds in the brokerage account just continue to do what they have been doing, but it's going to make him lose sleep at night. And he says, I don't want to do that. So let's look at the solutions then. Solution A, 100% whole life insurance. What we'll look at here is moving the money that's in the brokerage account into a whole life insurance policy. Now, in doing this, would he just write a check for $750,000 and deposit it into the life insurance policy? You could do that, but it would look ugly. We would not recommend it. That is not how you optimize the cash value of a life insurance policy. At his age of 63, it's going to make the most sense to spread that $750 out over 4 to 5 years. We'll look at 5 years here because it keeps the numbers clean at $150 per year for 5 years. So we just saw retirement without life insurance, what it looked like, the 50K per year. Now we want to see what it looks like with whole life insurance. Let's take a look. Okay, so first thing we want to see, moving the money from the brokerage account to the life insurance policy. You see the $150 going in, there's the policy. This is a Guardian product. Here's your $150 per year. Break-even point, just about year 5 in this example. He's paid in $750, he's got $745, and then the cash value just continues to grow. However, it's not going to look like this. And the reason why is because he wants to use this money during retirement. So let's take a look here. What do you notice? A lot going on. Let's start at 67 years old. Got the husband's Social Security, wife's Social Security, pension benefit, and there you go. There's the life insurance payment. Before tax, $86,000. After tax, $75,000 and change. Now, follow this red line. There we go. Jumps to $80,000. Why? Follow the red line. What I did here is at 73 years old, we increased the income coming from the life insurance policy from $30,000 per year to $35,000 per year. Why we did that is just based on inflation and what we've seen occur over the past couple of years. I don't want to lock him in just to 75K or make him feel like he's locked into that. So now he's got 80K per year. And he could even take more than that if he wants to, which is really nice. Now, with this policy, he still has money left over toward the end of his life. So he's taking income of 30K per year. That chart, we saw 30K per year coming from the policy until age 90. We didn't have the policy values there. If you want to see the full plan with those values, you can check out this video here. With that said, let's take a look at his life with whole life insurance. So how much income did he get? Well, before tax, it's about $89,000. After tax, came out to about $77,500. Where I came up with that number is because it was 75K, then we increased it to 80. Those are the after-tax dollar amounts. So I just split the difference there, just to make it simple. At age 90, if he's still alive, he's got $340,000 still in cash value that he can access. And he's had cash value all the way through. It's gradually been coming down as he's pulled 30K per year. My point is, he's liquid here. So he's got access to capital throughout the duration of his retirement. If he dies at 90, his kids don't get the 340. Instead, they get 390. Make sense? When you die, we don't get the cash value and the death benefit. The net death benefit is what's paid out income tax free. Okay, let's move on to option B. 100% annuity. I transfer $750 from the brokerage account to an annuity. Let's look at retirement without an annuity and then also with an annuity. All right. So first, the annuity. Here's what it gives him in income. So he deposits $750,000 right now, so at age 63. And then at 67, he's going to turn the income switch on. $81,000 and change per year. And it's guaranteed to last forever. So it's a fixed income payment, $81K per year. That hits his target income without any Social Security or pension income. So that's a huge advantage to this product. When you look at age 90, he's got almost $2 million that he pulled. So it looks pretty good. However, something very important to note here, before tax. Let's see what it looks like after tax. So after tax comes out to about just a little bit less than 70K per year. And then down here, the total income he received is about $1.6 million. So this is the exact same annuity product with the 81K per year coming out. We just punched in his current tax rate and estimated what it would be if he's taking the $81,000 per year from the annuity, and then calculated the after-tax amount. So we see how much he gets per year and the total dollar amount he gets. So when we look at the full picture, what do we see here? We see starting at 67 with your Social Security, pension, and then annuity, your total income's almost $140,000. What was his target? Do you remember that? 75K per year. And then over here, the after-tax income, first year 109, and actually comes out to about 116 per year, and then goes back to 109. It has to do with how we're pulling money from the annuity with taxation due only on the gains, not the principal portion. But we see how much we're getting every year, which is nice in this example. How much income did he get? Before tax, $140,000. After tax, $110K. Did you get enough income? Yes, you easily hit that target amount of $75K. What about age 90? Do you have anything left over? No, you don't. We don't have a cash balance with an annuity. What about money for the kids? Nothing left over. We've taken more than the $750 we paid in. So as we compare these two plans, what are the pros and cons? This gives you a lot more income, the annuity strategy, and you've got the word guarantee in there. But this is more liquid, where you've got money left over, so you could have accessed a little bit more than the $77.5 per year. You do hit your target income, you've got liquidity, and you leave money, but with this, you get a lot more money. And if you said, this is too much, like I don't need $110,000 per year, that's more than I've lived on ever, because it's net. The before tax is $140. What you could do here is say, all right, if I'm getting more than I need, I could take the extra $20,000 to $30,000 and save that. I could put it into a life insurance policy. Show me what that looks like. So that is an option there, but you could also just do that from the start. So here's our 50-50 split. So with this, same thing, $750 brokerage account, but we're going to split it between these two accounts. Want to see what this looks like? There you go. Equal split. We don't have to do 50-50. It keeps the example simple. So on the left, you've got your life insurance policy. On the right, you've got your annuity. Life insurance policy, we did the same thing, $75K per year for 5 years. We did take income at age 66 in this example because he did want to supplement some of his income. That was for a specific goal, which illustrates that you can do that, which is nice. But then we just let it ride. The annuity, we start at 67 years old, and you get about half of what we saw before with the $81,000 per year, which is pretty cool. So you see how much you're going to get. Same thing, we see the $40K before tax. After tax comes out to about $30,000 to $34,000 per year, which this is the dollar amount we want to look at in the full picture, his full retirement plan, or retirement strategy, I should say. So when we look at this, you see the before tax income and then the after tax income comes out to just over $82,000 per year. So when you look at that, the $82,000 per year, did it give him enough money? Before tax, 96. After tax, 82. Target, $75,000. So this plan gave you the money you were looking for in retirement through an annuity, and you will see the words on that policy, guaranteed income. So it gives him peace of mind, which is what he's looking for. He doesn't want money in the stock market anymore. And then he had that life insurance policy sitting on the back burner and growing the whole time. So at 90 years old, it's $865,000. And he's got several $100,000 that he has access to all the way up until 90. The benefit to that is if this is you, you've got the income that makes you comfortable. So now we don't have to worry about money. But if additional expenses pop up, you want to take the family on a vacation, you want to do something cool with your money, like buy a property or something that might produce more income, whatever it might be, you've got cash value that you can use all along the way. And then if he dies, his kids don't get the $865. Instead, they get $930,000 income tax-free. Make sense? Here is an easy way to recap it. How much income do you get? All whole life, $77.5. All annuity, $110. 50-50 split, $82,000. But then you see how much money is left over with each. Well, down here, got a lot more money left over. Then also, if this is important to him, or important to you, if this interests you, you see how much money is left to the kids or your beneficiaries. We've got this boxed in red because that one I did like the most. However, it's always up to the individual. My big thing is mapping things out, showing the different options, and then you can pick the one you like the most. And if you don't like any of them, you don't have to pick any of them, because it's totally up to you. What we like to do is map this out so we can see the actual strategy and what it looks like, which is a lot of fun to do, and then work with someone throughout the duration of their life with the initial setup and then the ongoing service. In the event things change, we want to access the life insurance policy, what do we need to be aware of? All that fun stuff that we often talk about in our other videos. So let us know if you enjoyed this video. If you have any questions, please feel free to leave them in the comments below. We've got another video that goes through the full plan of this individual or for this individual. And as always, I hope this helps.